All right, fantastic. Well, welcome everyone to our first ever ERA live session. These virtual sessions will take place frequently throughout the year and will feature electronic industry experts and peers who will present a variety of hot topics. Today, Walter Tobin, ERA CEO, will lead the discussion, and we are most lucky to have our first ERA live guest, Dennis Reed, Senior Research Analyst at Edgewater Research with us. I know most of you know Dennis, so thank you for being here, Dennis. Dennis will be presenting an informative mid-year industry market report, providing a quick review of the first half of 2023, then diving in to give you all a peek at what the second half of the year looks like. Before we get started, please remember to mute your devices. Also, if you would like to ask a question, please either utilize the raise hand function or the chat box. Claire and I will be monitoring that. We'll field questions as we have time available. With that, Walter, I will turn it over to you.
Thanks, Erin. So these calls used to be known as our ERA water cooler calls. And because we figured out quickly that nobody is left hanging around the water cooler because we're all out back selling. So we have now repurposed them and rebranded these calls to ERA Live. And we are just thrilled to have Dennis as our inaugural speaker on ERA Live. You know, Dennis is a senior research analyst with Edgewater Research, headquartered in Cleveland. And Dennis has really become a trusted source inside of our industry. He has spoken at many of the ERA chapter meetings. He has spoken at the ERA conference in the last couple of years. He's a highly rated and regarded speaker at the ERA conference, and he's really a smart guy. So please give me your attention. Prepare to be amazed. And without further ado, I'm going to turn it over to Mr. Dennis Reed. Dennis?
Thank you, Walter, and thank you, everybody, for joining. Boy, those are big shoes to fill between being the first presenter on ERA Live and then all the accolades that you've given, Walter. But I do appreciate it, and looking forward to run everybody through. As Walter and Erin mentioned, not only where we've come from through the COVID years in the early start of 2023, but more importantly, where we're going in the back half of the year, and then ultimately an early look into 2024. So just to start a little bit with our agenda today. So quickly, I'll cover, for those of you who don't know us, I'll cover who we are at Edgewater. Then we'll discuss the cycle and where we see us as an industry in the cycle. We'll talk a little bit about the disruption in the industry outlook. Then we'll shift over to the supply side fundamentals of our business, the demand fundamentals, and then we'll wrap up with our sales forecast across the three major product areas, being semiconductor, passives, and then the interconnect markets. So who are we at Edgewater? We're an independent research company. We specialize in technology, internet, and consumer and e-commerce. We work with not only some of the largest money managers in the world, so think of the people who run your pensions, 401ks, hedge funds of the world, but we also work with some of the largest technology companies in the world in our tech practice, supporting them in providing critical business insights through our fundamental research process. We've been doing this a long time. Our reputation dates back over 2 decades. Collectively, on our hard technology firm, we bring well over 55 years of experience. So we've seen several cycles, each are different, and we'll try to draw some comparisons into what we've seen in the past, but more importantly, what's going to happen going forward. And then why Edgewater is mentioned. We're deeply connected within the industry. I live and breathe in the supply chain, doing 100+ Zoom, Teams, phone calls with people like yourselves. As I mentioned, we are a trusted resource for the investment community, and it does position us with an interesting view into the markets, because we ultimately get to see where the investments are going, both from a public and private standpoint, which we could ultimately help shape our thoughts about what's going on in the industry and where it's ultimately going. And then, as mentioned, we are a critical partner with all the largest global technology companies, identifying trends and assisting them to shape their strategies to grow profitably in a relatively uncertain environment. I won't cover this too long, but how to engage, please reach out. My background information is here using one of those crazy screens that apparently takes you to it. If not, I think Aaron and the team at ERA will have the slide deck available on the website, so my contact information will be there. We are new members to the ERA, which is exciting, and I haven't poked around enough, but I'm guessing there's a way where you could probably also look me up on the website as well. So plenty of ways to reach out, and I'd welcome hearing from all of you. So where are we in the cycle, and how does this compare? As you can see, when you look at the cycle, there's been kind of mixed reviews, I would say, of what's going to happen. Is this going to be deep in a V shape? Is it going to be a U shape? Ultimately, what letter in the alphabet are we staring at as we've clearly passed peak sales in the industry, which was October of 2022. And to tell you what this compares with going back, right now, it looks like it's closely monitoring the 2011 industry correction. I think there's a couple of things that are important for that. One, when you look at 2011, there was a black swan event with the financial crisis, and then ultimately a rapid recovery coming out of it. And again, not making light of the COVID environment and the humanitarian crisis with it, but clearly that was a black swan event for the industry. Very short, significant disruption, and then ultimately a very, very robust recovery coming out of it. So what does that net out? And I think this is where it gets interesting. We view this cycle as somewhat of a, to borrow the letter description, we view it somewhat as an L right now. We don't think peak to trough is tracking overly deep. However, what I would tell you is the recovery is going to be a longer slog, I think, than most are expecting. So to put some numbers behind it and where we're trending, this doesn't appear to be an October 2000 or a dot-com implosion where peak to trough from sales was close to 42%. It also doesn't look like the black swan event in 2008, 2009, where it was a 36% decline in sales. What it does look more like to us, again, is that 2011, where the peak to trough level ends up somewhere in the 12-ish, so call it 10 to 12% overall. And the good news is we're right about there. Sales are about 90% of where they were at the peak on a monthly basis. So that's a good news. Also, I would tell you, we provided some analysis in terms of, how long do these cycles take? And it's interesting when you think back with all the cycles going back actually to 1990, the median peak to trough, or time from peak sales on a monthly basis to the low point of the sales, is actually 8 months. So when you think about it, where does that put us right now? Right now in June, we are sitting at month 7. So if we have a median or relatively average down cycle, this could be the bottom in overall semiconductor sales, which is very, very much a good thing. And again, something I think that's worth celebrating, because it's been tough out there as we look back through this year. The downside to that is, how long does it take to recover? The narrative entering this year was 1Q, we burn inventory, 2Q, we burn inventory, and then 3Q, 4Q, we're back off to the races, and we're gonna regain peak sales, et cetera, et cetera, et cetera. If you look at history and our view on the market, and we'll dig into this deeper as we go through the slides, we simply do not think that it will be a quick recovery. The median months in a down cycle to return to peak sales is actually 23 months. If you look at the 2011 correction, which is what we're tracking the most closely to, it took 25 months for us to reach peak sales again in the industry. So as we think about this on a monthly basis, that's putting the recovery time period, again, not saying we won't grow year over year next year, but it's just the math equation of when we return to peak monthly sales. That puts the recovery time period somewhere in, call it September, October, or November of 2024. So when we think about this and we look forward, I think the message that you'll hear consistently throughout the presentation is the sky is not falling. We're working through inventory. You're better to plan your business conservatively and then ultimately chase growth should that growth opportunity arise. As we look at what's causing this, and I'm sure everybody on this webinar is very well aware of it, at the end of the day, we have a demand issue in most of the end markets that we serve. Compute, consumer, and communications account for about 75% of industry sales for the semis, and all of those markets are extremely challenged. What we're seeing right now is that challenging, and then ultimately the loosening of supply has started to shift its way into the auto and the industrial marketplaces. Really, when we look, and we'll touch in the end markets at a deeper level, when we look at the demand environment, close to 80 to 90% of the demand environment right now in 2023 is down. Quite simply, it's hard to grow when 90% of your industry sales are facing demand problems. But again, we'll touch on each of the end markets and what's going on behind the curtain with each of those in the next couple of slides. So this slide's busy, and I've used this in the past, but the most important thing is we're seeing some of the bigger market prognosticators start to realize what occurred over the last 3 years is not reality. And again, I've asked this rhetorically multiple times to many people. The pre-COVID growth levels for semiconductors ex memory was 3%. And that number shot up to 6% when you include COVID. And then just the COVID years were almost quadruple what the growth rates were. So rhetorically, I would ask everyone, can you think of a market of size that is growing at a 4x rate of what it did pre-COVID? And the answer is quite simply, it hasn't. The good news is a number of people follow some of the major market prognosticators, and they've actually revised their forecasts down. So now we're looking at a 9% number ex memory, which is better. And again, I think, which is overall in line with our view of this decade, which is somewhere of a 7 to 8% type growth environment for the decade when you average it out. So the good news is the long-term forecasts are starting to reflect reality. And I think ultimately, the quicker that we reflect that in the reality, the quicker that we can move inventory through the system. Because at the end of the day, we don't have a demand problem right now. We have an inventory problem. So do we have a banking crisis? And it's remarkable what we've seen over the last several years. And I've shared with several people on a call, I really feel for Bernie at his presentation at the ERA National Conference, which took a much more optimistic tune than the year prior. While I can't disagree with Bernie's view, unfortunately, since Bernie spoke at the national conference, we've had not just one, but two, but three, actually 4 banks fail. That's concerning. And it's concerning to me from a couple of standpoints. One, it's shocking to me broadly that we're not talking about this within the industry. And the reason that it's shocking is what it ultimately does to our customers. The largest of the large customers, they're going to bank with your major financial institutions, your JP Morgans, your Citigroups, et cetera, of the world. Those banks are clearly fine. But when you get more into that channel-driven industrial customer, my guess is they're banking more with your regional banking companies. And if you look at Silicon Valley, Signature, and now First Republic, those are regional banks. They each have their own risk profile. They each have their own poor risk management story. But not digressing on this, at the end of the day, the cost of doing business is growing substantially across our customer base. And when we mix that with a higher level of inventory, it's a challenging operating environment. And just to prove that, looking at some of the major distributors in our market without naming names, looking at the 2 majors, their average day sales outstanding, so basically their time to collect payments going back to 22 years for distributor one was 82 days. Exiting the first quarter of this year, they were at 111 days. Distributor two has performed better. It's more in line with their averages, but I would tell you with distributor two, there's some idiosyncrasies within the companies that are leading them to manage their financials more closely. The bottom line, again, as I mentioned on the previous slide, the cost of doing business is higher. The cost of holding inventory is higher. And that overall, we think is just going to lead to a much more conservative operating environment. And as we look at where that plays out from an inventory standpoint, inventory is still elevated. So we track inventory levels globally to the tune of $270 billion exiting the first quarter. While this data is obviously dated, you know, what I would tell you is a couple of things. One, on a dollars basis, we are significantly above pre-COVID levels, 67% actually on a dollars basis above COVID levels. Now, I will also caution you with, at the end of the day, the dollars number is misleading. We're all very well aware of what's gone on with pricing. So we do think it's better to look at it at a days basis, which should capture that inflation as it's a financial calculation between inventory dollars and cost of goods sold. And while it looks better, we're still seeing days of inventory 30% above 1Q19 inventory levels. So again, while we've made some progress on dollars, we haven't made progress on a days basis as sales have started to slow faster than inventories got out of the system. So again, as I mentioned, you know, right now we see the entire supply chain going forward is more inventory challenged and oversupplied than we do any real demand destruction long-term in the marketplace. So how did we get there? Unfortunately, in our industry, we just can't help ourselves. So this is the capacity, the CapEx spending across the semiconductor supply chain. So it includes the compute. So guys like the memory suppliers, your CPU, GPU suppliers, your foundry, your analog suppliers, your passive discrete suppliers. And if you look at the year-over-year growth, we had roughly 10% in 2020 coming out of the 18-19 correction, low 40% growth, and then 10% growth in 2022. Unfortunately, that is the first 3-year window the industry has seen double-digit growth since 1998, 99, 2000. And we ultimately know how that ended. Now, again, going back to one of the earlier slides, we do think this cycle is different. We think the demand is a lot more realistic, but we've clearly added too much capacity. Likewise, when you look at the makeup of this, my mind quickly went to, I certainly understand what transpired in the memory marketplace through COVID, certainly understand what transpired with the CPU, GPU players, and ultimately the foundries as well. So it can't be that problematic when you strip those guys out. Unfortunately, with the exception of 2021, it actually looks worse. The analog and the passive suppliers have added more capacity on a relative basis than you saw in terms of dollars spent than you saw in the overall supply chain. Now, it's interesting to note, and it's great to look backwards, and we know there's too much capacity going online, but it's interesting where we sit at the near midpoint of the year in 2023. It honestly depends on the supplier and it depends on the product family that they are in terms of their capital deployments for the rest of the year. While overall CapEx spending has not changed, what I will tell you is we've heard from various suppliers, most prominently in the passive space, there is a push to only install the factory shells right now and delay equipping of the factories. One, the demand's not there, and two, it's a financial calculation with depreciation schedules of 30 years on an empty shell relative to a 5-year depreciation window. So again, there is some moderation in terms of the actual unit growth that's coming from a capacity standpoint, but at the end of the day, we're going to have to grow into the capacity. We're going to have to burn the inventory out of the supply chain. As we shift to demand, how did we get here? So, again, going back to that first chart, the next 2 slides will be on the compute market, or 3 slides, sorry, will be on the compute marketplace. When you look just at core PCs, and I know for most of the ERA audience, core PCs and the PC OEMs are not typically accounts and markets that we serve. At the end of the day, there fundamentally was about 100 million units that were pulled forward in demand during the COVID window. And how did we get to that number? The long-term trend was about 275 million, plus or minus a couple of million. That number went to 300 in 2020, 330 in 2021, and then 293 in a down year, still about 20 million above pre-COVID levels. You add those up, we're at about 95 million. So we've got 100 million units of installed base that we're working through. And we probably all could think about that in our businesses or our homes where we've made incremental PC purchases. So again, going forward, what I would tell you is we've seen signs out of Asia in particular that the orders for core PCs have stabilized at a low level. So that's very much goodness. But unfortunately, they're not rebounding. And we think this year will be about 250 to 260 million. Next year's forecast is calling for about 263 million. So again, in those 2 numbers, we've taken about 25 million of that 100 out of the marketplace. So we do see the PC market overall as a tougher slog going forward. As we shift to the server market, the first and foremost I would tell you as you look at this slide, our forecasted down 1 is probably low in terms of what others are thinking, but it's still way too high of what's going on in the marketplace. The real number will ultimately be probably down somewhere in the 5 or 6% range. But really, there's a dichotomy in the marketplace across 3 emerging trends for server. One being the enterprise space, and enterprise demand is just muted, and it's muted for several reasons. One, on-prem server spending is delayed and or weak, really because they're underutilized assets, as many workers had been remote and the reopening has been uneven at best. The second is the core data center spend. The core data center spend was quite robust through the COVID years as everybody shifted to the cloud. But as you think conceptually about that business, a data center supplier, they need to have the capacity installed before their salespeople can sell it, right? They can't go to Walmart and say, move your whatever system to our cloud and then not have the capacity built. So they built, and now they're in a digestion phase. And then the third, which we'll touch on the next slide, is AI. When we look at the artificial intelligence market, it's actually quite fascinating, and kudos to the team at ERA for the number of sessions back in late February and March. The timing could not have been better when the LLMs really hit the mainstream, hit the media. And it's an interesting dynamic, and we've tried to frame, what this means going forward for everybody. So while there was a tremendous amount, and there still is a tremendous amount of excitement around the opportunity from a content, from a server growth, from a use case scenario, what I would tell you right now is it's not a case of rising tide raises all ships. Right now, as I mentioned on the previous slide, what we are seeing is the data center budgets coming out of x86-based architectures and moving into more CPU-based architectures. So near term, the spend is flat to down, with significant upside in the AI side of the house and significantly downside in the x86. I think AI in general becomes a much more interesting product when it gets out of the phase that we're in right now. Right now, it is very remarkable, very cool to see what it could do. But really, your killer use case from an AI standpoint can't be helping kids cheat their way through college papers. Where it becomes really an interesting use case to me is when you combine artificial intelligence with the Internet of Things, and you start looking at deploying these solutions and the ability to learn and interact with people really in an environment that goes from billions of devices to trillions of touch points. That's when you start to get into a market growth or a market size in the late 20s, early 30s that starts approaching roughly $100 billion in annual sales, which, just to put that in perspective, that's the equivalent of roughly 25% of this year's semiconductor sales globally. So it is a huge opportunity, not making light of that by any stretch of the means. But I would tell you right now, it's an arms race. So you're seeing a near-term pull, but it's only benefiting a handful of suppliers that are highly levered to the AI and to that part of the data center. As we shift gears to the smartphone, and I'll touch on this one just really quickly. The problem is we've got a major demand issue here. It is primarily stemming from China. So as we look, smartphones were down roughly 10-11% in 2022, and we're thinking in aggregate they'll be down 2 to 3% this year. From an OEM standpoint, effectively everybody excluding your major company based in Cupertino is down. The biggest downside has been in China, and the entire idea that China would rebound post-COVID has simply not happened because it turns out the Chinese people are like us in the Western world. When they were allowed to go out and socialize, they opted for expenses that were more driven by the soft economy: travel, meals, shows, tickets. And we ultimately see little change in that through year end, unless the Chinese government decides to dramatically step in, which we're not in the business of necessarily forecasting what the Chinese government will do. As we shift from more consumer-centric markets to markets that impact more of the members, I do think it's interesting to look at the auto market and where we are this year at the start of the year and compare it to last year. So last year on Jan 1, 2022, there was 19 days worth of inventory level at the dealers, and it was close to 85 days before then. Where we sat right now from a national average was close to 45, 50 days. So we've seen a significant rebound or replenishment of dealer level inventories. What's more important as we think about auto this year and into next year is what is that makeup? And I circled several of the vehicles that are below the national average. And if you notice, it's minivan, compact, subcompact SUV, compact SUV. And unfortunately, that creates a mixed challenge for our industry. Whereas the other side, midsize SUV, luxury, sports car, luxury compact, et cetera, they are all above the natural average. So as we look at automotive for this year, what I would tell you is we don't have the tailwind like last year that we had from a dealer level inventory standpoint. And we also don't have the mix shift benefiting our industry. But as we go through, we'll also highlight several of the opportunities that are the goodness on that side of the equation. It's just important to note that the fundamentals entering this year are drastically different than they were this time last year. So what does that mean for production globally? When we look at production globally, this year actually feels a lot like last year to us. So last year there were 78 million units built. The forecast at the start of the year were close to 87 or 88 million, so roughly 10% downside to those forecasts. This year, the forecasts across the industry were in the mid 80s. Our number puts it in the low 80s. So at the end of the day, we think that we're looking at a year where global auto production is flat. The makeup is important. As I mentioned, we see the mix in the internal combustion engine and the inventories as a headwind for the supply chain. And I'll touch in a couple of slides our outlook for EV, but that still remains a major tailwind. And then again, as we look to next year, we're thinking again, low single-digit growth and still remaining well above that mid-90 level production levels that we saw in kind of 17-18 period. The good news is everyone I'm sure is well aware from an electronics standpoint, Even the lower end minivans, compact cars, they are becoming more electric. So there is a content opportunity even on the low end. It's just naturally not as robust as we see in the more premium luxury vehicles. So as we look at sell-through this year, so far, this has actually been an area of goodness, I would say, for the industry. So the SAR forecast going back to the year was about 15.5 million units for the United States. Year to date, we're tracking right in line with that number. It's somewhere right between 15.4, 15.5. So that is goodness. We're looking at roughly 10% unit growth here in the United States from a sell-through standpoint. That is the goodness. The challenge is, again, the mix and the makeup. That unit growth has been entirely driven by backlogs for enterprise sales. And I'm sure anybody who's rented a car recently has probably noticed you're seeing a lot more vehicles in the fleets with 5, 10, 15,000 miles, where this time last year, those vehicles were 50, 60, 70,000 miles. So you're seeing the fleets ultimately being replenished, which is helping the unit number. You're not getting the kicker with the premium auto purchase, and ultimately the OEMs putting us as consumers on allocation. So walking through, what does this mean for the year? I'll kind of give you kind of our take on an upside scenario, a downside scenario, and probably a realistic scenario on where we see it. So if everything goes right, and what I mean by everything goes right, interest rates go back to zero. We have no concerns over inflation. There are no supply chain disruptions. We could build what we want. We could deliver what we want. Best case scenario, it's probably a 16.5, 17 million max number. So again, very, very impressive growth if everything goes right. I feel comfortable, while I'm by no means a macroeconomist, I feel comfortable saying that best case scenario is quite simply not going to happen. Car prices are up, interest rates are up, and I think they'll stay up for a while. And that's ultimately going to taper the consumer purchase. Your downside scenario for this year is probably 12.5, 13 million units. And how do you get to that downside scenario? You see some type of major economic environment. You see you have no supply chain issues. You see a major economic disruption. Interest rates still remain high, and the consumer ultimately stops buying automotive vehicles. That leaves you with roughly a 12.5 number in our mind that's mainly driven by the fleet sales. So it takes us to what's kind of the realistic number right now. And actually, we're tracking to that. We think that 10% unit growth from a sales standpoint is probably where end demand will shake up. That kind of factors in higher payments, strong fleet sales, and then ultimately the average miles driven of a vehicle is up substantially. There does become a case in point where you have a major mechanical failure that drives the change in or that drives a new vehicle purchase. And we think that's kind of factored in our forecast, again, is roughly the 15.5 million units. We're staying on trend with where we have been through year to date. As we shift to EVs, nothing really has changed here. And I know this is a slide that I used actually in Austin last year. And I did pull it out because we still feel comfortable in terms of the mix penetration. In 2020, there were 1.7 million vehicles. 2025, we feel good with the 8.5. And then we ultimately think it's a 50+ million vehicle by 2040. What's more important to us is what this could mean for all the people selling components into the space. And again, just in a pure play EV, you're selling to the big OEM in Austin, you're selling to the big OEMs in Detroit. You know, we think overall EV revenue was about $7.5 billion for electronic contents in 2020, and it could be $12.5 billion by 2025, which again is very, very strong, very, very robust. But the interesting and the more exciting thing is when you look out between now and the remainder of the decade, if you assume those unit forecasts are correct, and it's 26 million units, and your average content stays about the same, we're looking at roughly an $80 billion market in 2030. And again, when you add that to the AI marketplace of 100 billion, now we're starting to quickly approach 50% of today's sales in two end markets. So again, going back to an earlier slide where I said, you know, what's a market of size that's growing at 4x the industry growth? We don't have the market of size yet, but they're coming. And where it gets really, really exciting is, let's just say that content triples. Somehow just this marketplace could be potentially almost half in and of itself of what today's sales are for semiconductors. I would challenge everybody that if we're right in the market's 81 billion, that's tremendous growth and something to be excited about. If we're right and it's 240 billion, that's obviously more exciting. My point being is anywhere in between those numbers, the growth opportunity still extending from the electrification of our automotive fleet is there and really unchanged despite the near-term macroeconomic uncertainty. As we shift gears from auto into industrial, just wanted to show manufacturing here in the US at the highest level. And what you've seen by the red line is it's clearly moderated. So we're in an operating environment where manufacturing is in the very low single-digit growth environment. And as I touched on earlier slides, we've got an inventory problem. So when you add those two together, you know, our outlook is for overall content, you know, while there's tremendous content opportunities between robotics, electrification, energy efficiency, in a digestion year, which we think 2023 is, we do have the industrial marketplace somewhere down in the high singles to 10% range. Again, purely driven by somewhat of a mathematical comparison, right? It's harder to grow off a hard base with total manufacturing, but more importantly, what's going on with the inventory balances across the supply chain. We see that as a drag for the year and think that we won't have any clarity until we get into arguably 1Q 2024. It's important to note, though, as we look at the dichotomy between manufacturing and then manufacturing excluding automotive, or transportation, I should say, transportation has been punching well above its weight in our overall economy for the last 6 to 12 months. When you strip manufacturing, which includes car, truck, airplane, train, all of transportation, we've actually flipped negative for the year. So again, within that, and what I would tell you when we look at the back half of the year and where we sit right now, transportation still remains a relatively good market. Now, there's going to be puts and takes with inventory, and when I talk of transportation, I'm not just talking the big three in Detroit. The trucking universe is severely antiquated. There's a push for EV, which we've talked about the content opportunity. There's a push for automation, and then there's also an increased push for safety features. So you're seeing our trucking fleets need to be modernized. You're seeing it with rail transportation. You're seeing it with air transportation as well. So again, transportation to us is still a good, healthy, long-term grower. But again, at some point, and there are some puts and takes here near term with just inventory, mainly impacting the internal combustion. We're not seeing engine. We're not seeing any impact within the EV space. As we shift over to military, you know, I think everybody's talked, and if you serve military within your territory, you're probably well aware that the military business has been good. And so we tried to frame it and put a little bit of, you know, try to put some numbers around it. And what I would tell you is, yes, by all means, the military and demand environment is good, but it's really unchanged from what we've seen over the last 20 years. As you look at total defense shipments or manufacturing, it's been on a long-term steady increase thanks to our friends in Washington. And without poking holes at anybody's political affiliations, what I would tell you, what matters within the defense budgets is not necessarily how much is being spent, it's what it's being spent on. And that's where the goodness for our industry comes into play. Right now, the Pentagon in Washington, they are planning for the war of the future. The war of the future is much more digital, it's hypersonic, and it involves a lot more technology. And again, not to be a warmonger on the call, that's good, I would guess, for anybody that's calling on your defense contractors. When we look at the near-term disruption with stemming from Ukraine, I think it's honestly more of a timing disruption. It's more of a timing impact on when the Ukraine war started and when the military business ultimately shows some legs. And what I mean by that is, and again, by no means am I making light of the humanitarian crisis. When a war or a conflict happens anywhere in the region, governments worldwide start shifting produced assets to the hot zone. And that's currently what's happened. And as they're retooling, to put it in our industry's lingo, ultimately the governments are using yesterday's war systems in yesterday's war, because the view is the days outside of this conflict, the days of marching soldiers across a line and battling with tanks and infantry is really expected to be in the past, with the emerging conflicts that are largely stemming from Washington or believed to be in Washington stemming from China. So again, defense spending, we think, in the electrification of the defense budget is a long-term secular tailwind for our industry. Defense is obviously contract driven. So depending on your program, you could be on a program that ramps hard in a year, down another year. But I would tell you, when you measure it over decades, we see no change in terms of the strong high single-digit growth, if not better, over the long term, as our military and our defense budgets look to more electronic solutions to fight the wars of the future. As we shift to our sales estimates, for those that saw our or have seen this chart before, previously our sales forecast was down 4%. For the total industry, and this includes memory. We have cut that to 12%. The big delta versus our previous forecast and now is coming from memory. We have the memory number down somewhere in the 35% year over year basis. When we look at the non-memory components, the marketplace is much more skewed to kind of a mid-single digit 5.5% growth. So again, as I would say for this year, and I think I would hope most would agree on the call, after the last 3 years of record sales, if our industry is down 5% for the year, that is a really good orderly downturn. The difference I think that we have versus other market prognosticators is we're much more muted on next year. Next year, we have up 3%. And again, it all goes back to inventory. We think the inventory will be a much longer slog to work through the system than I think others are thinking about. And then in 2025, we do have the market going back more to that mid single digit type growth environment in the 7-8% range. As we shift to the interconnect world, we do expect the performance to be a touch more muted than our semi forecast. We have the interconnect space at down 6. Really, the delta, I would say, or that point of difference between interconnect and the semi space is purely in the non-cancelable, non-returnables. The interconnect suppliers were not nearly the prolific users of non-cancelable, non-returnable programs. And as a result of that, their sales are correcting, and then ultimately we think will rebound a little quicker. For next year, again, we have the environment up low single digits, and we do think the long-term trend within the interconnect space is 5 to 6%, and that's driven really on the 2 markets that we touched on earlier for long-term growth drivers. 1 being artificial intelligence and the growth of the data center, and 2, electric vehicles. And then lastly, just to round out the major product categories are the passive marketplace. And again, in passives, we think this is the most challenged of the markets that we follow, with our year calling for a down 8 in 2023 and more of a flattish number in 2020. Really, the delta between passives and others is driven by the consumer marketplace. We see increased competition predominantly from Asian-based suppliers within the passive marketplace, and we do expect that to keep the industry more guarded or muted relative to interconnects in what relative to the semi space. So with that, I'll just wrap up with what's on the horizon, and I'll let Walter touch on bullet point 1. So I'll skip to 2 and 3. But just be on the lookout. Some of you may have seen we have a new distributor report that went out Monday. Happy to share. Also coming out with additional data offerings. And as I mentioned earlier, my contact info is on the ERA website. Please feel free to reach out. We'd love to chat with everyone on the call. And with that, what questions do we have?
Anybody wants to raise their hand or unmute the mic and ask Dennis a question, we can take questions. So Dennis, that was a great presentation. Thank you very much. And it really is just overwhelming. The amount of data that you have is overwhelming. And so we're at a couple of people. The call has been recorded, so people will be able to access the information, Erin, on a recording.
Yes, that is correct. I will be sharing the recording link with Claire this afternoon, and we'll get that posted on the ERA website.
Perfect.
Mhm.
So
like
if there are, oh, here's a question from Dominic.
Yep.
Do we expect, hang on, let me just read it here. So Dominic, do we expect interruptions in supply as fabs transition from offshore to onshore? Dennis, any comments on that? He's asking the audience, but we'll probably just ask you for your thoughts from Dominic.
Yeah, Dominic, I think that's it's a great question, and you know, the short answer is I think any fab transition has the risk of doing that. My guess is the suppliers who do that have moved fabs and or are using some type of fab light model by and large with flex capacity. So I think there will be minimal disruption from just the pure move with onshoring. You know, the area that I would say that we're more focused with the onshoring is just the ultimate cost, right? And when we think about the cost curve going forward, as I talked about earlier, the cost of doing business is more expensive. The cost of issuing debt is more expensive. The cost of equipment is more expensive. And ultimately that has to manifest itself in higher ASPs. So, you know, the thing that we don't have a great handle on with reshoring is how does this play into inflation and then ultimately the elasticity of demand within every end market that we follow. If the goals are met, and there are several OEMs that are targeting, you know, eliminating or de-risking from China and Taiwan in certain verticals by 2025, one, that's impossible. But two, if that's met, the cost to do it will be significantly different. And I don't know at this stage what that means for end demand.
So there's a follow-up question. John Lanzillo, if you want to unmute your mic to ask Dennis the question that you posted in the chat room, John.
Yeah, I see the numbers tell the story, what you talked about, but do we see world politics really going to be our alarm bell for some of our industries that we're in now?
You know, I would defer to Bernie's outlook a little bit, and as I touched on a little bit, you know, I have long since given up trying to forecast and predict what Mr. Putin or China will do from a geopolitical standpoint, because I just don't have an edge there. But I think we've always had geopolitical disruption, right? And maybe it's much more acute. Maybe there's more reaction right now. Maybe there's more of a push with some of the nearshoring efforts right now, right? It's clearly rippling through. So I don't want to minimize that, but I would like to think cooler heads would prevail, because if China decided to invade Taiwan, my gut tells me the shortage that we saw and the disruption that we saw over the COVID years would pale in comparison. And so I would like to hope cooler heads on both sides of the Pacific would prevail. But again, it's kind of anyone's guess. And it's clearly, when we talk about tailwinds and headwinds, I think how we look at it, I wouldn't consider the overall geopolitical environment is necessarily a tailwind for operating conditions, right? It's clearly more of a headwind. And then how it manifests itself, whether it's major disruption, whether it's inflation, as I talked about in the last question, it's kind of yet to be seen, but it's definitely a more complex, challenging environment than it's been in recent times.
Yeah, that's good response. I have a second question I wrote. Does research show that colleges or other schools are helping train factory workers for this reshoring, onshoring? Do you see any of that?
At the end of the day, I think that's the biggest challenge I think that we have. There's a couple of challenges, right? So let's look at it in a vacuum with the largest handset OEM, who manufactures a lot of products in China and installs nets on their factory ceilings 10 years ago. Without naming names, they've got a goal to move 25% of their iPhone production. Oh, sorry, I just said it. 25%. Sorry, 25% of their production. Walter, I was trying to be good.
It's all right. It's okay.
That's good. That's good enough.
Yeah, 25% of their production to India by 2025. If you're a connector supplier and you don't have a line in India, you now need to figure out your logistics, your trade, all of that stuff, which adds cost. And that customer wants 2019 pricing right now for that product. That's a problem. That's just on the cost side, right? When you look at the labor, so then what do you do to mitigate it? Vietnam's a potential, right? So Vietnam, 50% of the labor costs of China, same shipping routes. They don't have the people or the trained workers.
Yeah.
So it's not a viable option. So we could look at Mexico. Okay, maybe a little better on the labor availability, less, inflation's a problem on the wages. Last year, 18% of all industrial leases were based on Chinese firms. So you're moving to Mexico for a Chinese parent company under a different name. So, that's a couple of the challenges, but, to go to the core of it, and I've been asked a number of times, when you look at the CHIPS Act and things like that have been passed through, it's great if our politicians want to make the investment or spend the money or whatever the case may be. But unless we could find a way to run these factories 24/7 with the skilled labor, we're just not competitive. And there doesn't seem to us to be an appetite to really address the root cause, which is we don't have the labor to do it. So until we do, I think we're somewhat, we're somewhat chasing our tail to some extent with it.
John, great questions. Thank you. Dennis, Bruce Scoggin, you want to unmute and ask Dennis the question that you posted?
Yeah, my question, Dennis, when you're looking at your EV numbers, do those include that peripheral market that includes the chargers, the required infrastructure upgrades, and all that technology that's going to go into supporting that support market?
Bruce, great question. And the short answer is no. That is purely just if you're selling to an EV manufacturer, an OEM, being the guy in Austin or Detroit or whatever. What I would tell everyone, and I mentioned this when I did a deep dive at the national conference in 2022, while those numbers are exciting and impressive and everything else, the real opportunity is in, Bruce, what you mentioned, right? There's three pillars that are needed to make this work. There's your automotive OEM, whether it's your traditional Detroit-based, your emerging ones. There's your utility companies generating the electricity, and then there's kind of your grid infrastructure, which are your more, industrialized, kind of companies. Collectively, those three pillars haven't worked together, which is a challenge. But again, fundamentally, I think for any of those EV numbers to work, we've got to figure out generation, transmission, and storage globally. And those numbers, I think, if that 81 billion number is right in 2030, I think those numbers could easily match that number and be a kicker, which is a pretty big kicker.
Right. Good. Great question, Bruce. Thank you. We are almost at the hour. So I just want to close the call by Dennis, something alluded to on his first point on his slide. ERA is proud to announce the launch of our ERA Business Environment Survey, which is going to be in partnership with Edgewater Research, which is the organization that Dennis is a member of, and also a brand new recognized resource of ERA. The first survey will be sent out to ERA members on July 3rd. We will be posting a press release sometime in the next week before July 3rd. There'll be an email sent to all ERA members. The survey will come from Edgewater Research. So will be some instructions to make sure it doesn't go into your spam folder. When you fill out the survey, the data will be collected under a non-disclosure agreement. The data will be collected by Edgewater Research. It will be harmonized and aggregated with all the other respondents. So your data will be kept very confidential. So you don't have to worry about the data being exposed for your individual company. It will be aggregated, and the results will be posted on the ERA website behind the membership password. So ERA members will be able to see the results of the survey. We would love the more people that participate in the survey, the better the results are. So please look for the press release coming out from ERA National in the next week. Look for the email of introduction and instructions coming out from ERA to you, and then look for the email that's going to be sent from Edgewater Research, which will contain the survey, how you fill it out, how you register, and there's 20 questions that you fill out, and the surveys will be sent out every month. So the more people that fill it out, the more cadence we can develop. The results posted under the ERA website for members only. The more robust the information is to help our members, guide them on how to, the different benchmarks of what the data shows, and to help you run your business. And it's a real great value-added resource to our members, and we're delighted to be partnering with Edgewater Research and certainly with Dennis Reed. So look for the emails, look for the instructions. It's a very exciting announcement for ERA, and we're very honored to be partnered with not only Dennis, but with his organization to give a real nice benefit to our members. With that, Aaron, I'm going to close the call. Yeah, Dennis, go ahead.
I'd add one thing on the email for those of you who don't like repeat emails. The faster you fill it out in the month, the less emails you get.
You can run, but you can't hide.
Good point,
So,
Dennis.
thank you.
All right.
Aaron?
Well, yep. Thank you, Walter. And thank you, Dennis. That was a very informative session. Thank you, everyone, for joining us today. Our next ERA live session will be hosted Thursday, July 3rd, which will feature a presentation by Sam Richter, who I know a lot of you are familiar with. He's spoken at the ERA conference several times. He will be giving a deeper dive on the new ERA SearchLink AI tool that is now available. So if your company is already using SearchLink AI or you are thinking about implementing it, you are strongly encouraged to attend that session. Again, that's on July 6th. And thanks, everyone. Have a great week.
Thank you.
Thank you. Thanks, Dennis.
Nice job, Dennis.